Any
You're
issue?
on. Here's your mic.
Copy. Oh, great.
Dan Tower, CEO of Cadillac Formula One, and you're watching Taking Stock.
The risk-off trade back firmly here on Wall Street in no short order as we officially kick off the final 4 trading months here of 2025. And of course, the first trading day here for September, that September swoon coming in back in full effect after last week we had so many storylines, all-time high after all-time high. Had a little bit of that pullback in Friday's session, but really setting the stage for a fair bit of profit taking today on this Trading Tuesday, especially for a lot of those big tech companies. All 7 of the so-called Magnificent 7 big tech companies, they are down in negative territory. And depending on the tail of the tape in the last minute or so, we are expecting to see all 11 of the S&P 500 sectors finish down on the day. Those lagging sectors include real estate, tech, and financials. As for the Dow 30 components, those household names we track very closely in the day-to-day financial markets. The leaders on the day include Boeing, Merck, and McDonald's, but a rotation out of those big lagging names, which include Nike, Goldman, and NVIDIA. Today on the show, in just a moment, he's on deck, folks. Mark Newton, he is a CMT from Fundstrat. We're going to talk all about the technicals, what he is seeing in these financial markets. We'll also speak with Sam Gaer of Monarch Asset Management. Just got down here to the trading floor. We'll talk with our good pal Phil Rosen, editor-in-chief of Opening Bell Daily. He is standing by, as are the team from ProShares. Time now for the ringing of the iconic closing bell right here at the New York Stock Exchange. And with that, the team from ProShares here doing the honors at the New York Stock Exchange. A fair bit of profit taking, like we said off the top of the broadcast. And welcome to one and all people who are just tuning in on Cheddar as well. We'll bring you the tail of the tape for this Trading Tuesday, the first trading day of the month of September, as is historically the case, a bit of a weaker time of the year for equities, right, Peter Tuchman? As we know that to be the truth.
Great rally on the close. $3.5 billion to buy on the close.
Peter Tuchman's popping in. Give us that a little bit in the close.
There was a $3.5 billion buy program came in on the close. That was the rally that came in from about 2 o'clock, marched all the way to a great post at 350. So
I appreciate the context.
Significant influx of buy orders.
Could have been worse.
The beginning of each month, normally there's a big influx of buy orders,
yeah,
right, as the funds come in and put some money in. So that's what you saw today.
All right, appreciate the context. Thanks for being here. S&P
Pleasure.
500 finishing down about 0.7%. The Dow 0.5%. The New York Stock Exchange index similar, and the small caps down about 0.6%. Mark Newton of Fundstrat joins the show now. He's also a CMT, and you know we love getting into the technicals and seeing the charts. Thanks a lot for being on the show today.
My pleasure. It's great to be here. Thanks.
So talk to you about what you're seeing in the markets, and how do you position yourself and kind of people you talk to about what to expect for the seasonality element of September markets?
Well, look, September got up with a bang. I mean, stocks and bonds are both lower. We heard comments from the ECB that they were reluctant to consider cutting rates further. So we saw a massive uptick in rates across the globe, and the UK gilt yields are up at the highest since 1998. So U.S. yields are in much better shape despite all the concerns about tariffs. We're actually pretty subdued when yields are still down about 30 basis points just in the last couple months. So, you know, we are still in a rally time for treasuries in my view, and equities haven't shown sufficient deterioration to think that we're really starting to show any sort of larger sell-off. So look, the key thing is this: sentiment remains very subdued, to say the least. People are outright bearish. Difficult after a 33% rally we've seen in the last 20 weeks that people are still on the sidelines. If anything, that provides a solid backdrop given a dovish Fed, the fact that earnings have been resilient, you know, a pretty decent economy, to think that markets still can push higher given all this negativity.
Yeah, what do you see in terms of the kind of the frothy valuation conversation? You hear the bears say, well, if you look at forward PE multiples, you look at how the big mega growth, the big tech stocks that are so consolidated, look at where they're traded relative to forward earnings, maybe some concerns there. How do you approach that side of the bear argument?
Yeah, I really try to exclude all fundamentals if at all possible. Look, it's always tough using an intrinsic value and saying, well, it's above it, so now it's negative and we need stocks to sell off. that never works as easily as planned. You want to use a combination of technicals and fundamentals. Stocks like Palantir, they got up, rose so quickly in the last year, they had a monthly RSI rating of 95, so incredible. So look, we have seen some deterioration in some parts of software. There has been some bifurcation in technology. Tech hardware giants like Apple up 10% the last month, one of the best parts of technology, whereas software has been down pretty sharply. So that is one point that I would say investors need to pay attention to, is when a leading group like tech starts to waver ever so slowly, that could bring about an eventual pullback. I don't think it started today. Market should rally back to highs. I am more worried as we get to October. The next 2 months, seasonally speaking, are some of the worst and more volatile of the year. You have to be prepared for that. Right now, technicals haven't given you any reason to want to fight this tape.
Yeah, you mentioned RSI, Relative Strength Index, and I always want people to watch the show and say, I learned a little something I didn't previously know. What are some of the other key technical indicators you most closely follow, even if you look at a broader chart of SPX, for someone to become a more informed technical investor?
For those that do not use technicals at all, I would say having a weekly MACD, MACD indicator up on the top in front of your view at all times is important. So that's moving average, convergence, divergence. It basically is two different moving averages lagged by a slight amount. So when you see crossovers and MACD remains bullish, it really remains proper to stick with the tape and not try to fight trends. And so look, I think trend following, watching for stocks that are breaking out to new high territory, be it daily, weekly, monthly, and or breaking down, much more important than saying, well, MACD or RSI or stochastics is doing this. You want to look at broader trends and what they're doing. Look at the correlation between equities, treasuries, the dollar. Right now, I mean, the dollar and rates arguably have started to turn down, and that's bullish for risk assets. So that makes me a little more constructive over the next week.
Yeah, we'll certainly see what the rest of the week and the rest of the month has in store. Despite the seasonality pressures, the VIX back above 18 for the first time in a while today. But we'll have to have you back, Mark Newton.
So one final note, if I can. Look at what gold is doing, being above 3,500, a breakout back to new all-time highs in the precious metals at a time when real rates are coming down. People have concerns about fiscal uncertainty. Precious metals are one of the best areas to be if you don't want to own U.S. stocks. So look at the metals.
There we go. Let this man cook. The great Mark Newton. Great to have you here.
Thank you very much.
Great to be here. Of course. Let's go for a walk, Bobby. We're going to talk about a few key NYSE notables. By the way, the great Joe Dente. Didn't know he was going to cameo. We always welcome onto the show, Joe Dente, of course. All right, time now for part of the show. We usually talk about earnings, but I almost said it's Monday. It's Tuesday of a holiday week, so we're a little late on earnings today. So instead, we'll talk about two NYSE notables that I think really underscore the risk-off mentality today. Bobby, we'll start with look at one of the big tech companies down here at the NYSE. That's shares of Oracle. You can see only down fractionally 0.3% or so. This stock is 3.5% of the entire XLK technology ETF, set for earnings next week. Up 32% year to date, but down about 14% in the last month. That tells you that tech trade kind of taken off the table. But then we rotate, Bobby, and let's take a look over this way. One of our key kind of recession names we watch very closely in consumer staples. That's Walmart, up on the day. Not a lot of companies are trading in positive territory. Walmart bucking that trend, down 7% since August 8th, but the one-year price target on Walmart sits at $113 a share. That's upside potential of at least another 14, 15%. Two different tails on the tape, depending what sector you're in. Folks, take a look now at the latest from Money 2020's own Scarlett Sieber, Money 2020's Chief Strategy Officer. Have a look.
Welcome back. I am Scarlett Sieber from Money 2020, and we are back with another riveting example of everything is fintech. Well, we take in these lovely cups here a random company that is a New York Stock Exchange listed company, and I have a guest, in this case, the lovely Tina Lomparik from Money 2020, to tell me why this company is actually a fintech company. Tina, you're gonna have 30 seconds. I'm gonna pull a name out of the hat. You have 30 seconds to tell me why it's a fintech company. If you do not do it in time, butter coming.
All right.
I
am ready.
Please go for it.
Oy. Okay. Home Depot. Okay. 30 seconds?
Yeah.
All right. So Home Depot is the fintech because they offer buy now, pay later. So if you're short on money, you can pay later next month. They also offer credit cards with special Home Depot perks and benefits. And they do, of course, digital payments options such as Apple Pay. So I think that is why Home Depot is a fintech.
You did that in less than 30 seconds. That's very
Oh
impressive.
wow, I could have talked more.
You could have talked more. Tell me.
You didn't have to. I didn't have to hit the buzzer.
No buzzer. Okay.
All right.
You can use the buzzer on me, but go ahead.
Okay.
I will pick
You will pick one.
from the magic hat here. Walt Disney Company. Why is Walt Disney Company actually a fintech? Well, first of all, have you ever been to Disney? Do you know the things that happen at Disney? Have you seen their magic bands? It's basically the perfect example of a closed loop fintech system that gets you all your payments, everything in one place, unlike anywhere else. They also have branded credit cards. I mean, I don't know. They to me seem like fintech incarnate.
Yeah, and it's the happiest place in the world.
That's
And
what
you
they say.
and you haven't hit the 30-second mark.
Winning.
The buzzer is very quiet.
Dang it. All right. Your turn.
All right. Okay. Nike. Ooh, I love Nike. I know that you love Nike because Scarlett is a big sneaker fan. So why is Nike a fintech? Nike is a fintech because they have their own sneakers app where you can order your own custom-made shoes and pay through the app. You can also, just like Home Depot, buy them later. If you don't, you can buy them now and pay later if you don't have money right now.
Time's up.
Oh no! Oh
You didn't quite get it. Well, it's all right. You were in a good flow there, and I mean, once you start talking sneakers, there's really no end.
I think I deserve a second chance.
No, it's my turn now. Okay. So we're gonna go with GM. GM. Mary Barr is on the wall upstairs here in the New York Stock Exchange. Why is GM actually a fintech company? Well, let's be honest. They have a lot. They do connected car payments where you can do payments for fuel, parking, tolls, all integrated within the car, especially over in the Nordics and other places around the world. They have data-driven credit models. There's a lot that's going on. If you're thinking insurtech, fintech, they're kind of one and the same. They give you auto loans, leases, you name it.
Everything you need.
I feel like of any non-fintech company, GM is at the top.
Amazing.
You were a great guest, Tina. Thank you so much. And that is all for this episode of Everything is Fintech. Want other companies to have us do other companies here? Throw them over in the thing. We'll make it happen. We're raining companies that are fintech at the New York Stock Exchange. Until next time.
Let's do it, folks. Welcome back to the show. Time now for the latest in the world of fintech, crypto, and AI. First up, Bitcoin trading around $110,600, up more than 1% on the day, with a fair bit of momentum behind BTC price action. Ethereum, meanwhile, hovering near $42.75, slipping about 2%. Next up, the Trump family amassed as much as $5 billion yesterday alone after the launch of their crypto token, WLFI. The Trump family windfall raises questions about the use of presidential influence in crypto markets and potential conflicts of interest that come with it. And finally, the crypto IPO pipeline is heating up, to say the least, with Figure Technology Solutions seeking more than $520 million and Gemini looking to raise up to $361 million. They join a growing list of digital asset firms going public, riding a wave of strong IPO demand and surging crypto prices. That's the latest you need to know. Let's now bring in Sam Gaer. He's Chief Investment Officer of the Directional Fund at Monarch Asset Management. Sam, it's great to have you here on the show. Welcome.
Thank you.
Of course, I'll hold the mic for you if you want. This way you got your hands, you can gesture as freely as you want.
Probably help me if I don't.
Talk to us about your work at Monarch and how you see yourself and really the firm situated in the broader digital asset landscape.
Certainly. So Monarch Asset Management used to be known as MNNC. We recently took on a majority investment from FalconX, and I joined the firm as CIO of the Directional Fund. We run 3 different funds within the fund. The Directional Fund, as I mentioned before, market neutral fund, as well as a Bitcoin denominated fund. And so we kind of fit into the digital asset landscape as a hedge fund, as an active manager. We participate in everything from yield enhancement, staking, market making, and as of late, digital asset treasury vehicles have become a really burgeoning business for us.
Yeah, I feel like they become a burgeoning business for a lot of firms out there, and anyone who has even a loose familiarity with financial news headlines is sitting there every day saying, wait, another treasury play, another treasury play. What are the basics of this newly emerging ecosystem people should know about, and how does Monarch play in?
Yeah, so I'd actually first like to demystify it,
Please.
if you don't mind, because a lot of people talk about digital asset treasury vehicles. What are they? So I think it's important to understand that, number one, this is like more of like a crossover sort of asset, much like a crossover song in music, where you have access to crypto broadening. You have active management of funds, and at the same time, these funds are creating their own momentum in the marketplace via structure. And so access, what do I mean by access? If you're an endowment or even an individual, for example, that doesn't have access to crypto, doesn't want the complexity of crypto, as we call them, rails, or setting up the accounts, etc., you can now access different crypto assets through digital asset treasury vehicles that hold and manage assets, such as Bitcoin, Ethereum, Solana. The Solana ones just came out today, which was a really nice one. Just in the context of that, you have you've now broadened the access to crypto to not just folks in the crypto sphere, as we call it, but to everyday average investors. Sure. It's important to note that these are actively managed assets. These are not ETFs. So if you want an ETF, that's a passively managed asset. You buy an ETF, you buy $10,000 worth of IBIT, you bought $10,000 worth of Bitcoin essentially. These are actively managed funds where a treasury vehicle will take your Bitcoin or buy Bitcoin, for example, and then buy more Bitcoin by selling more shares,
Sure.
Which then increases its own NAV.
Absolutely.
And then they end up buying more Bitcoin and selling more shares, and that's what we call the flywheel effect.
Yeah. It's an incredible space. I don't mean to cut you off. I got to get to a hard break, but it's an incredible space. I hope you'll come back and rejoin us because the technology is exciting and it's ever evolving. Sam Gaer, thanks a lot for taking time. It is really good to have you, folks. Stick around. The latest on startups, raises, and rounds, plus an interview with our good pal Phil Rosen of Opening Bell Daily. Don't go anywhere. Much more Taking Stock coming up after this. Let's do it. We're so back. Time now for the latest in the world of startups, raises, and rounds. First up at this hour, AI startup Anthropic just pulled in a huge $13 billion funding round, puts its valuation at $183 billion. Hello, marking one of the biggest bets yet in the world of AI. Next up, the state of New Mexico is committing more than $300 million to become a hub for quantum computing. channeling state funds and federal support into labs, startups, and infrastructure. And finally, YouTube superstar Mr. Beast, yes, the one and only, reportedly planning to launch his own phone company next year, using existing major networks to power the surface. That's the latest you got to know in the world of startups, raises, and rounds. And now, time for probably my favorite part of the show. Don't tell him I said that. Phil Rosen, our good pals, co-founder and editor-in-chief at Opening Bell Daily. Join us here every Tuesday. Thanks for being here.
Thank you for having me.
Okay, so you and I are here chatting. It's the first day of September. We know about the seasonality-related headlines. What do you follow into a month that historically has performed the way it has for equities?
So we are actually coming off the best summer in 40 years, right? So we have just been ripping higher all summer. Bull market has been nonstop. But today was the first day of September, and it is living up to its expectations of a very bad month. This is the worst month of the year, dating back 75 years for stocks. And I think on average, we see a 0.7% decline in September. And after today, we're right on track for that. So what you want to look for this month is really the Federal Reserve meeting on the 17th. That could be the catalyst that, let's say, bucks the trend of a weak September, because the rate cut could be the exuberant factor that we are looking for as far as giving stocks a reason to rally and say goodbye to all the negative seasonal trends.
Yeah, I think it was last year's September meeting for the FOMC. That was the first big cut. And I say big because I think they came out with 50 basis points, which caught a lot of market participants off guard. We know the Fed is data dependent. We'll get a few important pieces of data between now and the 17th. Talk to me more about what you think the Fed will be looking for to better inform that decision in a few weeks' time.
So right now we're at about 91% odds, according to the market, of a rate cut, 25 basis points this month. Wow. And the Fed's going to be looking at more inflation data. We have a Friday jobs report. And frankly, it's going to be very difficult for the Fed to push back on those market expectations, right? We're over 90%. And if the Fed does anything except a quarter point cut, that's going to be a radical interruption for the market.
What else do you think will be among the bigger contributing biggest catalysts to the market? We got NVIDIA earnings behind us, got that PCE print finally behind us, but hey, we like to say in this business, you just wait a few more minutes, something else is invariably going to pop up. What do you be following?
So the seasonality is the biggest driver right now, I think, and that Fed rate cut is going to be the thing that turns the seasonality on its head. However, what I'm going to be watching, seasonality or not, worst September ever or not, the fourth quarter is always great for stocks, just about always. 80% of the time in the last 50 years, stocks finish higher in the fourth quarter. So that's something to watch. And analysts have already been raising their earnings expectations for the fourth quarter, so that bodes even better for the coming few months ahead. So if you have a bad September, you can almost bet on a good last 3 months of the year anyway.
Yeah, we'll certainly see what investors have in store. You know, part of this is like, I wonder, I'm about out of time, but like if it's like the back to the school phenomenon, people are kind of checked out, they forgot to kind of rebalance their portfolios, or how much of it is just like psychological? It's like you think September will be bad, and so September's less than optimal.
I always lean to self-fulfilling prophecy, right? If you think it's going to be bad, then it's bad. And it's just investors playing into the market there.
Well, I got to tell you, I knew this interview was going to be terrific, which is why it was terrific, but also it's because it was with Phil Rosen. How could it not be? Phil is the co-founder and editor-in-chief at Opening Bell Daily. My man, thank you as always.
Thank you.
Good to have you, brother. We'll see you again next week. Folks, coming up after a quick break, I chat with bell ringer Mo Haghbin of ProShares. Don't go anywhere. More Taking Stock is coming up after this. Welcome back to the show. We are live on the floor of the New York Stock Exchange, and you're watching Taking Stock. And time now for a one-on-one interview with Mo Haghbin. He's managing director at ProShares. Just rang the closing bell right here at the New York Stock Exchange. Mo, it's great to have you. Thanks for joining us.
Thank you for having me.
First, the experience for you and the ProShares team to not only be here at the NYSE, but who in the business world does not want to be up there on the podium? What was it like for you?
It's a great experience. We had some of our clients here, and nothing quite like it. Love being at the NYSE. This was a very special event.
Talk to me more about what you and the team at ProShares are seeing in the broader macroeconomic backdrop. I would never get sick of asking questions like this because everyone's got a unique take. There's so many things going on. What are you most closely following in these markets, Mo?
Yeah, well, look, I think it's really, really difficult not to be optimistic about this market. It's been a great year. Obviously, we've had some challenges with the tariffs, and the macro backdrop hasn't always been certain. But if you look at what the market has done, it's been incredibly resilient, and we continue to be very positive about it.
Yeah, you are. So you have more. You maybe see more of a bull case or a bull thesis playing itself out, even between now and the end of the year.
Absolutely. I think with the Fed looking to be more accommodative for the back half of the year, with some of the regulatory kind of clearing and some of the work that the administration is doing around that, it's hard to see really a catalyst why the market would be soft towards the end of the year. Obviously, this month is going to be a slower month. We've seen some volatility, but it's hard not to be optimistic through the course of the year.
Yeah, I mean, that element of seasonality for what we usually see for equities in September, you now make like the fourth guest on the show. We've talked about it with, but it's important to underscore for people who have been paying attention to these markets. They've gotten used to all-time highs to know we do have some seasonality at play. Talk to me about the broader ETF landscape and how you see ProShares uniquely positioned in that conversation.
Yeah, well, look, we've been in the industry since 2006, so nearly 20 years. We've been very focused on innovation and product development, and we continue to focus on that today. And one of the important things is always staying close to your clients and listening to your clients, and that's what's been at the center of our success over the last 2 decades.
Correct me if I'm wrong, but I just saw the statistic at the end of last week. More ETF pure play products now exist than actually publicly traded companies. How do we get to this point?
Well, look, it's been an amazing, amazing trajectory for ETFs, and I don't necessarily think that's going to stop. To me, the fact that there's more ETFs than stocks isn't really the news. The news is giving investors choice, giving them access to capital markets, and some of the innovation that's happening around public and private or defined outcome strategies. Ways to shape your risk and return in the portfolio are fantastic, and I think it's great for investors.
Yeah, what have you seen in terms of institutional or retail investor interest in the core ETF products that ProShares specializes in?
Sure, yeah, so we have 2 lines. We have a tactical line, which we think about more as professional traders and institutional clients, and then we have a buy and hold core line, and we see demand for both, actually, and really that's the conversation with clients, is how to build a portfolio. So it's not about active or passive, ETFs or non-ETFs, it's how do I actually create a portfolio and make a better financial future for me and my clients.
All right, fair enough. By the way, do you have a favorite ETF? And if you did, are you even allowed to say it?
I'm not allowed to say it.
I had to ask anyway.
They're all my favorite.
They're all your
You can't
favorite.
pick a favorite child.
Yeah, correct. Hey, that's the way to do it. I appreciate you being on the show, Mo Haghbin. Great
Thank you for having
perspective.
me.
Congratulations on
Appreciate it.
doing
Thank
the closing bell. That's Mo Haghbin joining us from ProShares. All right, we got 1 minute to wrap, I'm being told. And with that 1 minute, going to give a special shout out and a huge thanks to all of our guests who joined the show today. I'm also going to give you a quick preview of what to expect here on Wall Street the next few days, because tomorrow, no shortage of earnings. We'll hear from Dollar Tree, Macy's, Salesforce, Figma. Do you know we got Figma's earnings call tomorrow? That's a big one. They just had their anticipated IPO here at the stock exchange. Later on in the week, we'll hear from Broadcom, Lululemon, and DocuSign. And of course, on Friday, the August jobs report. All important. You don't want to miss it. Tomorrow morning, 9 a.m., NYSE TV Live with Kristen Scholler and FinTech Live with Remy Blair. Both will count you down to the open. That's going to do it. This is the Stock Exchange. This is Taking Stock, and we will see you again tomorrow.